Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome back, practitioners. Look, if you advise clients operating in the service industry, or honestly, if you prepare returns for anyone earning gratuities, your landscape just shifted in a really major way. Today, we're walking through a comprehensive explainer on the brand new Section 224 tip deduction. You've probably seen it in the headlines. It was famously introduced in the One Big Beautiful Bill. Now, as trusted advisors, you know perfectly well that a catchy headline like "No tax on tips" rarely tells the whole story when it comes to the Internal Revenue Code, right? So, our goal today is to equip you with the exact statutory mechanics, the phase-out math, and the strict compliance requirements, so you can confidently guide your clients through this entirely new terrain. So let's just dive right into our roadmap for today. First, we'll cover the new tip deduction law. Then, who qualifies for deductions. Third, caps and income phase-outs. Fourth, taxes that still apply. And finally, employer reporting and record keeping. All right, kicking things off with Section 1, the new tip deduction law. At its core, the Section 224 deduction is a federal income tax deduction that allows qualified taxpayers to deduct up to $25,000 of certain tips received during the year. Now, structurally, it's a below-the-line deduction, and you're going to claim this on the newly created Schedule 1A. But here is the absolutely critical takeaway for your advisory practice. While this does eliminate federal income taxes on tip income for many individual filers, it is not a blanket exemption. I mean, the IRS rarely makes things that simple, do they? It comes with some very strict limitations and highly specific definitions of what actually constitutes a qualified tip, which we'll be breaking down in just a minute. It's also super important to understand the implementation timeline here. The bill was signed in July 2025, which means the deduction is officially available starting this current 2025 tax year. But next year, in 2026, the IRS is rolling out mandatory form updates for W-2s and 1099s to actually accommodate this tracking. So the really crucial point to communicate to your clients is that this is a temporary legislative window. As it stands right now, the deduction sunsets after the 2028 tax year. So unless Congress swoops in to extend it, you're looking at a 4-year strategic planning window for your clients. Moving right along to Section 2, who qualifies for deductions? Okay, there are a few hurdles to clear. First, the taxpayer absolutely must have a valid Social Security number, and it has to be issued before the due date of the return, including extensions. Second, and listen, this is a massive trap for the unwary, married couples must file a joint return to claim this. If they file married filing separately, that takes the deduction off the table entirely. Third, the tips have to come from a job that customarily and regularly received tips prior to 2025. The IRS has designated over 70 occupations that fit this bill, so no, as a tax preparer, you cannot claim a tax-free tip from a really happy client. Finally, there's the Specified Service, Trade, or Business, or SSTB provision. The tax code actually has a rule denying this deduction to SSTB workers, but the IRS just announced they're delaying enforcement until they issue further guidance. So for 2025, SSTB workers can actually claim it, but you are definitely going to want to watch this space closely for future years. Next up, we really have to distinguish between qualified and non-qualified tips. For a tip to be deductible, it must be paid entirely voluntarily, totally free from negotiation, where the customer gets to dictate both the amount and the recipient. This covers cash, credit cards, checks, and valid tip pools, but you've got to be careful with automatic gratuities or service charges that get tacked onto a bill. Those are not qualified unless the customer is explicitly given the option to modify or remove them. Also entirely excluded are tips paid in property or digital assets. And perhaps most importantly, the IRS is on high alert for recharacterization. That's a situation where an employer tries to artificially lower an employee's hourly wage and just make up the difference in quote-unquote tips to exploit this deduction. That is not going to fly. All right, Section 3, caps and income phase-outs. So the absolute maximum a taxpayer can deduct is $25,000 annually. But pay really close attention here if you're advising married clients filing jointly. That $25,000 cap applies to their combined total qualified tips. It is not a per-spouse limit. If both spouses are, say, bartenders earning $20,000 in tips each, their deduction is capped at $25,000 total, not $40,000. Now, beyond that hard cap, high earners are going to face a phase-out based on their modified adjusted gross income, or MAGI. This phase-out triggers at $150,000 for single filers and $300,000 for joint filers. And the math works like this. For every $1,000 a client's MAGI goes over that threshold, their allowable tip deduction drops by $100. Let's actually see how this math plays out in the real world with a few client scenarios. Take Andrew. He's a waiter. His MAGI is low, his tips are under $25K, so he just deducts the full $18,000. Super simple, no limits apply. Then there's Becky. She has $30,000 in tips. Even though her MAGI is low, she hits that hard cap, so she can only deduct the maximum $25,000. And finally, we have Nicholas, a single tour guide. He only has $18,000 in tips, so he's well under the cap, but his MAGI is $160,000. Because he is exactly $10,000 over the single filer limit, his deduction gets reduced by $100 for every $1,000 over. That's a $1,000 total reduction, bringing his allowable tip deduction down to $17,000. Make sense? There is one more specific limitation you have to calculate, and it directly targets self-employed clients, like gig workers or independent contractors filing a Schedule C. For these taxpayers, the tip deduction absolutely cannot exceed the net income from the specific business generating those tips. So, if your client is a self-employed comedian who took a loss on the year after deducting all their travel expenses, well, their net income is zero, which means their allowable tip deduction is also zero, regardless of how many cash tips they pulled in at their shows. Okay, let's transition to Section 4, taxes that still apply. I really want to highlight this quote directly from the source analysis because it is paramount to your advisory conversations. Despite the no tax on tips label, the tip deduction does not eliminate all taxes on tips. Look, clients are going to walk into your office fully expecting their gratuities to be completely invisible to the government. You have to be the one to tell them they aren't. C, while federal income tax is eliminated on up to $25,000 of qualified tips via that below-the-line Schedule 1-A deduction, payroll taxes are entirely unaffected. Employees still owe their share of FICA, so Social Security and Medicare taxes, on every single dollar of those tips. Independent contractors still owe self-employment taxes on them, and most critically of all, clients might still owe state and local income taxes on this money. And that brings us to the surprisingly complex issue of state conformity. Because this is a below-the-line deduction, it does not reduce federal adjusted gross income. Therefore, if a taxpayer lives in a state that uses federal AGI as the starting point for state returns, this deduction is totally ignored at the state level. Furthermore, if a state uses federal taxable income but operates on a static conformity date established prior to January 1st, 2025, they aren't going to recognize this new law either. Basically, unless the state legislature proactively passes a bill to conform or create their own deduction, many of your clients are still going to be paying state income tax on these tips. Let's head into our final part, Section 5, Employer Reporting and Record Keeping. From a compliance perspective, we're currently dealing with a tale of two tax years. For the 2025 tax year, the IRS isn't updating any forms yet. Employers are just going to use the existing Box 7 of the W-2, Box 14, or standard 1099 reporting to track these tips. But look out for the 2026 tax year. The IRS will be issuing mandatory updated W-2s and 199 forms. These new forms will require employers to explicitly separate cash tips from other compensation and assign a specific Treasury tipped occupation code for every single tipped worker. The IRS waived penalties for 2025 to give folks a breather, but 2026 is going to be a different story entirely. So how does this translate into a concrete action plan for your business owner clients? Well, here is exactly what they need to do to prepare. Step 1. They need to identify the correct IRS tipped occupation codes for their staff, and they need to do it right now. Step 2, they must work with their payroll providers to ensure their software can actually separate and track these qualified catch tips for the new 2026 forms. Step 3, this is the perfect time to review existing tip pool policies to ensure total federal and state compliance, just to make sure those tips actually remain qualified. And Step 4, employers will need to have their tipped employees submit brand new, updated W-4 forms in 2026 to adjust their withholdings accurately. At the end of the day, the no tax on tips deduction is an incredibly powerful tool for service industry workers, but for employers and for their accountants, it represents a pretty significant compliance hurdle. The 2026 reporting requirements are going to be here before we know it, so I want to leave you with this final thought. As a trusted advisor, how are you going to proactively audit your clients' payroll systems this year to ensure seamless, penalty-free compliance by 2026? The clock is ticking, and honestly, your expertise has never been more vital. Thanks so much for joining me on this explainer. Ensure your practice is ready, and we will see you next time.